In this video, I'm going to talk about an idea that Donald Trump is floating that could completely change how the housing market works. It sounds like a simple fix. Let homeowners move without losing their mortgage. So let's talk about this idea, the portable mortgage. And let's talk about the reason it's getting attention in the first place. This is because it targets the exact thing that's freezing the market today. Instead of your mortgage being tied to your house, it would be tied to you. So when you move, you keep your interest rate. No reset, no payment shock. On the surface, that sounds like a breakthrough. But housing policy is never just about what sounds good, it's also about what changes behavior once millions of people respond to it. So we're going to walk through why portable mortgages are so appealing right now, the real benefits that nobody should actually ignore, but also the real problems that almost nobody talks about when they bring this up. And then finally, we're going to talk about what this would actually do to home prices and the overall housing market. Because this idea could definitely unlock housing, but it could also make it even harder to afford. So let's dig into it. So to understand why this idea is really so controversial, we need to understand what is a portable mortgage really. So let's define it crystal clear, because this is where a lot of the misunderstanding comes from. Right now, your mortgage is tied to your house, not to you. When you sell your home, your mortgage gets paid off and then you move on to a new one if you buy another house. When you buy another house, you start over with a new mortgage, a new qualification, a new mortgage rate. Everything starts from scratch. You do that whole process over again. And then you get a brand new mortgage that's tied to current interest rates and basically to your credit score, what it is today, not what it was 10 years ago. And that's how the system has always worked. Now, a portable mortgage flips that relationship entirely. Instead of the mortgage being attached to a specific property, it gets attached to the borrower, to you. So that means if you sell your home and buy another one, you don't lose your mortgage. You take it with you. You have the same interest rates, the same remaining loan term, and the same monthly structure. Now, the house changes, your location changes, but the mortgage doesn't. So here's what that looks like. You bought a home years ago with a 3% mortgage. Things happened, you need to buy a new house or you want to buy a new house. Whatever the case is. Under today's rules, moving means giving up that 3% loan and replacing it with something much higher. Think about it. A lot of people still have interest rates around 3% and under 4%. And the current interest rates float around 6% right now. And that's where we get into the lock-in problem that currently exists in the housing market. People don't want to move and lose their interest rate. So with a portable mortgage, you sell your home, you buy a new one, and bring that 3% mortgage with you. You don't have to refinance. You transfer the mortgage to a new home. And since this isn't refinancing, you're not renegotiating the loan. This is not a temporary rate buy down, and it's not the same thing as an assumable mortgage. With portability, the borrower keeps the loan, not the house, not the next buyer. And this proposal isn't coming out of nowhere. It's a direct response to what just happened to mortgage rates. For years, rates were historically low. Millions of homeowners locked them in. Then rates jumped. Suddenly moving meant doubling your payment in many cases, even if the price of the house didn't change, which in most cases it has. And so what that led to is homeowners stopped moving, not because they wanted to, but because the math stopped working for them. Higher interest rates mean higher monthly payments. And with this portable mortgage idea, it's designed to remove that, to let people move without resetting their entire financial life. The promise of portable mortgages are simple. Your mortgage reflects your past financial decisions, not the current rate environment. If you earned a low rate, you don't lose it just because life happens. That's the idea anyway. And now that we're clear on what a portable mortgage actually is and what it would do, let's talk about why people love this idea and why it makes economists, lenders, and housing experts extremely nervous. So now that we're clear on what it is, it's easy to see why this idea has so much appeal, because it solves a problem people feel every day. Right now, millions of homeowners aren't staying put because they want to. They're staying because moving would punish them financially. And now portable mortgages would break that lock-in. They let people move for work, for family, or for lifestyle changes without detonating their monthly payment. It also feels fair to a lot of people. If you made smart financial decisions in the past, if you locked in a low rate when you could, this lets you keep the benefit of that decision, not lose it just because life happened. And from a market perspective, this could finally get housing moving again. More listings, more transactions, less stagnation. So yes, on paper, this feels like a fix. But here's where things start to get complicated. Mortgages aren't just interest rates, they are risk contracts. When a lender issues a mortgage, they price it based on very specific factors: the house itself, the location, the local market, and the resale risk. That's the collateral. With portable mortgages, that collateral changes. The loan moves to a different house in a different neighborhood at a different price in a different market cycle, which means the original risk math no longer applies. So someone has to absorb the difference. Either lenders do, which means they price that risk in upfront, or the government does, which means taxpayers eventually pay that price. Portable mortgages don't eliminate risk, they shift it. And when risk shifts, systems change. So one of the other problems that would have to be addressed are the regulatory changes that would be needed in order for this to happen. For widespread adoption, the Federal Housing Finance Agency and Congress would need to approve major overhauls to how loans are securitized and priced to account for the changing collateral risk, according to the Bipartisan Policy Center. Investors would also demand higher rates to compensate for the added risk of loans collateral changing midstream, potentially negating some benefits. So a portable mortgage may even come with higher interest rates than a standard mortgage. That's another problem with this program. And there's another issue here that doesn't get talked about enough. Portable mortgages obviously only benefit people who already own homes. If you locked in a low rate years ago, you're going to win out of this. You get mobility, you get purchasing power, you get flexibility. But what about if you're a first-time homebuyer? Nothing there changes for the first-time homebuyer. You don't have a cheap mortgage to carry forward. You're still competing against sellers who now get to keep ultra-low financing. In fact, a portable mortgage could actually make existing homeowners even stronger buyers, because when your payment stays low, you can afford more house. Which brings us to the question everyone actually cares about. Would this raise or lower home prices? Let's talk about the short term. Prices would likely increase. Here's why. Portable mortgages increase purchasing power without increasing supply. More purchasing power, chasing the same number of homes, almost always pushes prices higher, especially in desirable neighborhoods, tight markets, and move-up price tiers. Over the long term, the picture gets a bit more complicated. More mobility could lead to more listings, but that only helps if supply actually grows. Portable mortgages don't build homes. They just make it easier for people who already own homes to move between them. And that distinction matters quite a bit. Liquidity is not the same thing as affordability. Now the next thing, this just treats a symptom, not the cause. This is the deeper issue. Housing isn't broken because mortgages aren't portable. It's broken because we don't build enough homes. Zoning restrictions limit supply, construction costs are high, labor is constrained, and demand keeps growing. Portable mortgages may ease pain for some homeowners, but they don't cure the disease. They make the system feel better without fixing what's actually happening underneath. If portable mortgages were implemented, here's what we'd likely see. More homeowners willing to sell, more movement in the middle and upper tiers, housing would feel more active, but affordability pressures would remain, especially for first-time buyers who don't get the same advantages. The market would move again, but it wouldn't reset. So portable mortgages aren't a crazy idea. They address a problem, like they reduce lock-in, they restore mobility, they make housing function better for people who already own homes, but they're not a silver bullet. They only shift risk, and they overwhelmingly favor people who already own property. And that'll likely push prices even higher before they ever touch affordability. So if you're asking whether this would lower home prices, the honest answer is, well, probably not. In fact, it's probably going to increase prices out of everything. It would change housing for sure, but it wouldn't fix it, especially for first-time home buyers, which are the ones that are suffering the most right now.